Welcome back to Morning Brief, brought to you by Invesco. We heard from Fed Chair Jay Powell last week. The time for interest rate cuts has come. More than 70% of investors are now pricing in a 25 basis point rate cut in September, but the size of that relief still remains an open question. Here to weigh in, we've got Ryan Wang, who is the chief U.S. economist over at HSBC. Ryan, what camp are you in? 25, 50? What would you like to see? What's the real reality?
Thanks so much for having me. Look, I think as we've gotten some more economic news over the past several weeks, I think that 25 basis point rate cut at the September policy meeting is looking more and more likely. Certainly, we did hear very clearly from Fed Chair Jerome Powell that the time to act is basically upon us. I think there's still some question about what the size of that initial move should look like. But given the overall comments on the state of the labor market, yes, labor market conditions are cooling. But we don't necessarily see an elevated rate of layoffs. I think we're more likely to see that more incremental start to the rate cutting cycle with that 25 basis point reduction.
What's going to drive the difference between 25 and 50 cuts at the next meeting?
Well, look, I would answer this in two ways. I think in the back of the minds of FOMC policymakers, they do want to have a sense of where they might be headed before making that decision about pace, right? I think that's really what it comes down to. Timing, how quickly you want to move policy into a stance that might be considered neutral or less restrictive on the overall economy. And you have to be forward-looking in a sense. But at the same time, if we don't really see that loss of business confidence that would be signaled from a spike in layoffs, if instead all we're really seeing is a less frantic pace of hiring, which is how Powell put it, then I think you have a little bit more time to be cautious, to move incrementally. You might still have in mind a destination, but I think there's less urgency to move that way in a very fast fashion.
I mean, we've heard more acknowledgement as well, or at least submission to the idea that it's not wages specifically that are continuing to drive inflation. So what is it? What is the larger, more outsized part of the mix that is still accounting for the most rises in prices that we're seeing?
Well, I think that's right. I think this is why the labor market data have been so important, because they, in a way, have a double implication. Firstly, it's just one half of the Fed's dual mandate. So when they see signs that the unemployment rate is rising, that labor market conditions are less tight, Powell talked about the decline in hiring rates and quits rates below their pre-pandemic levels back in 2018 and 2019. That's something to think about in and of itself. But also, I believe it's changed how the Fed is thinking about the balance of risks with respect to inflation. Now, if you look at the actual current data on inflation, you still do see elevated rates of services inflation. I think it does reflect the kind of what we've seen out of the labor market in the past 2 years, which admittedly has still been pretty tight. But also when you look at what businesses are saying anecdotally, comments about labor shortages are becoming narrower. There are still pockets of labor shortage, but in some cases, these might be structural shortages, particularly in skilled trades, where businesses may not even have an expectation that they're going to be filling their open positions. So when you look at all the data, I would say that it's those signals the Fed is paying the most attention to, and that's why that on the margin, they've become a little bit less focused on upside risks to inflation.
Ryan, what do you think about the slowdown in hiring that we've seen? And more broadly, how linked do you think that is to the talk that we've had throughout 2023, early 2024, that we were heading toward a recession? Did that kind of strategizing from the finance world impact hiring on the labor side of things? And does that read through raise eyebrows for you? I guess I'm just wondering if that was a problem.
Well, I think if you really look at it, 2 years ago, roughly at this time for the economy was probably the most intense phase of hiring. And it was pretty much also the peak in inflation pressure. So I think part of the uncertainty is that both have cooled down significantly over the past 2 years. But it's hard to say exactly what it means because it was such an unusual period. Businesses were hiring because we were in the midst of course, the unprecedented reopening of the economy following the pandemic. So you can understand why businesses were trying to hire so aggressively and finding that it was difficult, finding actually that voluntary turnover, that's what the quits rate signifies, was limiting the ability of businesses to add to their workforces. Now that's changed because a lot of those positions have been filled, right? And so The question is whether the labor market data are signaling something more worrying. And, understandably, we're always looking forward. So the next step after being comfortable with the current size of your workforce might possibly be a turn to layoffs. And I think in the data and anecdotally, we do not see evidence of that turn occurring just yet. But I think essentially markets are going to be somewhat nervous about this prospect for the rest of this year and into next.
And what would that translate for productivity, especially as we're continuing to monitor more broadly here some of the changes that are taking place in the workforce, larger kind of tectonic shifts, even whether that be technology based or whether that just be the workforce right now starting to feel a sense of burnout, especially in certain sectors. So how are you tracking what those layoffs would do to the broader kind of trends that we're seeing already start to take place and formulate within the workforce?
Well, that's really interesting how you point to two possible factors that could be supporting what we've admittedly seen as pretty resilient productivity growth over the past 1 to 2 years. Some of it's on the technology side, and of course that gets a lot of focus. But perhaps actually what we're seeing on the productivity side is also workers that are more comfortable in their current positions. Because again, we've just gone through this wave of just enormous turnover, business formation, worker transition. And actually, workers may now be in jobs that they're better suited to be filling, that they prefer because of all this turnover we've seen in recent years. And that may actually be boosting productivity, right? So that's a positive. However, by its nature, that's something that should be temporary or transitory, if you like, in the broadest sense of the word. But right now, I think the U.S. economy is actually benefiting from both sides. A lot of increased labor input, a lot of increased labor supply over the past few years, but also pretty strong productivity growth. And that's maybe part of the reason why even now we're still talking about U.S. GDP growth that, maybe is slowing below the 2% level, but it's not even totally clear. After all, the latest quarterly GDP number was still almost 3%.
Well, Ryan, it sounds to me like you're describing a little bit of the Goldilocks soft landing that Jay Powell is trying to engineer here. At what point can we declare that soft landing, and what is your call for the time horizon on that?
Well, I think I agree with you in the sense that I think there is some evidence in the data that that's potentially the way the economy is headed towards a softer landing. Now, I don't think there's any point, and I think FOMC policymakers would agree, that you can just declare victory. It just simply doesn't work that way. As soon as the economy transitions into a slower growth pace, you're going to be focused on, well, how do I prevent the next challenge, right? And I just think that inevitably, with growth likely to, at some point, to slow below the 2% level, with job gains slowing, with wage growth slowing, that implies slower income growth in the future. So when you look 1 year into the future, there's good reasons to expect that growth would slow further. I think the key really for the Fed is they're trying to figure out how to navigate interest rates to create that balance, right? And it's just a never-ending quest to try to keep the economy on an even keel, even though you can never achieve that perfectly.
Yeah, really great point, and certainly that is the challenge for the Fed and central banks around the world. Ryan, we really appreciate you joining us this morning. That was Ryan Wang. He is HSBC's chief U.S. economist.